Not only are the markets running towards all-time highs to finish up the year, but on their way, they're starting to set some records. The SPY Spiders Cash ETF just set the record for the biggest inflows ever, breaching $20.8 billion going into the fund last week, far exceeding a double from what we had at the highs of 2020, and even here off of the sickness recovery lows in 2019. So the market has to be overbought, right? It's got to pull back. That's the key question, right? Not necessarily. If we look at the data, 7-week winning streaks tend to be bullish for the market. There's far more of them than I would have imagined in the 50s and 60s, but if you look at the data table here on the right, generally speaking, we are looking for good things to continue to happen over a 1, 3, 6, and 12-month time horizon. If you wanted to cherry pick the bearish data point, of course, it's right here, ahead of the great financial crisis, but you're cherry picking one of 29 instances of this indication. So let's throw another one in the mix just to be a little bit more certain. Here's the RSI over 70 on more than 40% of the S&P components. Far fewer signals because it's a little bit more aggressive, but here we go. There's 1, there's 2, there's 3, and 4 and 5 are definitely more recent. And if you look at the data table over here, 100% of the time, 12 months later, we are looking for positive expectancy. Same thing with 6 and 3 months. 1 month out, 75% of the time, the market was higher. What's the reason for bringing all of this up in the intro of today's video? Because the next thing we're going to start thinking about is the trifecta effect for the return of 2024. If the Santa Claus rally is green, if the first 5 days of January are green, if January as a full month is green, generally speaking, we are looking for a green 2024 or full year's performance. So we'll keep an eye on all of that stuff, but the data we just looked at would suggest that 1 year out, we are expecting positive things to happen. Therefore, the longest duration here, the January return, should be positive. All three should be positive based on the data that we just examined. So is 2024 going to be a positive year? There are a couple of things that might provide headwinds. One might be the sentiment. Is the market overly bullish? I mean, generally speaking, when you get up and over 50% on the sentiment vote, starts to be like, all right, let's get a little bit contrarian here. And you know what the famous Warren Buffett said, be fearful when others are greedy, and we are tracking for extreme greed as of right now. So will the market take a tumble into the early stages of 2024? Let's take a look at what the charts might suggest. So let's begin on the SPY monthly time frame chart. This is actually the SPX because I want to illustrate some price history here. Generally speaking, if we're in a long-term bullish trend, the market tends to hold the 50-month simple moving average, and you can clearly see that we're interacting with the all-time highs after pushing away from and holding the 50-month moving average near the lows of October from 2022. If we just auto-zoom this chart, the folks who are worried about a big Armageddon-style crash, they're not taking into consideration that generally speaking, bad things happen when we do not hold the 50-month moving average, and we're just not even close to that at this point in time. There is no suggestion of a breakdown. We'll change our tone if it starts to come around the corner, but as of right now, not even close to the dot-com burst or the 2008 great financial crisis. If we look further in history, again, look at this period of bull market here where we hold. You get the gist of what I'm getting at here with the S&P holding that 50-month moving average. If we take a look from a pattern point of view, let's go back over to the familiar S&P 500 SPY Cash ETF. We are still on a logarithmic chart in case this looks funky to you. But for the most part, what are the patterns that would suggest upside activity can continue? Well, again, here's your low, here's your higher low. We know that this technically is a monthly cup and handle. So a measured move on the monthly time frame chart can help us understand what's possible from a technical perspective if the market continues to rally in the upward direction, exceeding that all-time high blue sky territories, right? It's like, where do we put some targets? Well, the most shallow measured move we have from this monthly pattern would be at the bottom of the pullback from the handle over here, and that 100% extension gets you much closer to 520, let's call it, for round number 6. So 520 is a good first target. Now, we're not forecasting that we go there in January, February, March, Q1, Q2, Q3. We're just pointing out where a theoretical target could be in the upward direction because we are trading with a bullish trend. Currently, there is no indication of a pullback, right? The next thing to point out here is that there's an even higher time frame pattern potentially in force, which is a quarterly bull flag. And generally speaking, bull flag's measured move always wants to come from the base of the flag. So let's do the same thing here with a Fibonacci extension. And this one is like a pie in the sky type target. Please do not misunderstand what I'm saying. I'm not talking about the S&Ps moving to, what would that be, 607 into 2024. But generally speaking, the idea that we're trying to convey here is that the charts on the higher time frames remain in the control of the buyers. If this is going to flip around, if we are going to see bears take control of the market for the new year, then generally this should turn into a double top. But what do we know about double tops? You need to bring in a lower low underneath the neckline of the pattern. The first sign of struggle to me for the S&P would be the failure to hold on to this level right here. If the S&P cannot hold that monthly higher low thesis we were describing back in October, then that's no good. The neckline is obviously in jeopardy, and at that point, if you could extrapolate out the 50 SMA, right, we're likely trading underneath the 50-month moving average, which, as we've seen throughout history, is generally not a good indication. So one step at a time. Currently, on the higher time frames, the buyers remain in control. We have what appears to be a secular bull trend. Let's get a little bit more granular. On the weekly time frame chart, I first want to talk about the 471 level, which was the prior flat top ahead of the all-time high and then the rejection from the upper wick. You can clearly see after today's break in the upward direction, we have closed above it. The weekly bar is not officially closed out. It's not Friday. It's not the weekend yet. But so far, so good. The upper wick of the previous weekly bar, which we noted was a character change, right, did not yield any aggressive sell-side pressure or any pullbacks that have dramatically impacted the trajectory of the all-time high acting as our target. If there is a pullback on the weekly time frame chart, we've been quite clear that 459, which is your prior pivot top from here and the top of the daily balance range, wants to act as a weekly higher low. This would certainly keep the trend up with a major higher low after breaking to a higher high. The weekly trend, of course, remains in the bull's favor. Let's take a closer look at the daily time frame chart and what actually unfolded on today's session with the break to a higher high. So if we're counting trend here on the daily, we know we're in an uptrend. We know that this has been a parabolic move. The FOMC certainly spurred some momentum in the upward direction, but we did experience a little bit of pullback happening here. We did drift into an hourly downtrend, so that officially cements this as the last higher low in the sequence. We're sitting on a higher high, so we can afford a higher low pullback to maintain the uptrend, and generally speaking, I would not want to see the weekly level violated at 471, which we were just talking about. If we can hold up over 471 on the daily, it's really holding up over the key weekly breakout point, and the all-time high remains the target overhead at 479.98. If we break down underneath 471, then this starts to look like a higher high double top, and then as soon as we get a lower low underneath the bottom of the neckline, which is currently sitting closer to 468.50, now it's game on for a deeper weekly pullback, and then we'll start to think about that 459 we were just describing on the weekly time frame chart. So as of right now on the daily, the breakout is looking good, but what's this pink line, you ask? Let's take it on down to the hourly time frame chart, get even more granular as we head into tomorrow's morning session. What do we see here? Certainly at the end of day, we got a little bit of a spike in the upward direction, and a spike just refers to an end of day breakout, right? And really, this boils down to the only reason the market stopped here is the market closed, right? The 4 p.m. bell rang and the buyers stopped being able to buy the market and send prices in the upward direction. So we don't know whether or not these prices are fair up and over that pink line. That level is at 474.50. I know we've got the laser light show going on tonight, but for tomorrow's open, if we can open over 474.50, in theory, the market should continue to auction higher in the search for sellers, right? We don't know if these are fair prices. We don't know if sellers would have stepped up here. The market closed at 4 and business was closed, right? That was that. So if we open in or above the spike, looking for continuation into 476.50 as your next upper target. If we open under the base of the spike, 474.50 in your SPY cash, then we'll look for a pullback. But what's the issue with the market? It's not really an issue. It's an issue for the sellers. It's definitely a good thing for the buyers. Buyers can still find a higher low structurally over 473.25, the retest of the Thursday high from last week. You'll notice that almost all of the consolidation today, not almost, all of the consolidation was above that 473.25. So the market does strike me as being far more bullish than bearish up here at these highs. And again, keep this in mind as a pivot for tomorrow morning's Wednesday open. If there is going to be a stronger reversal, you will likely flip into an hourly downtrend by producing some sort of lower high underneath 473.25. This area right here, which led to the breakout continuing, right? A lower high underneath starts to kick off that hourly downtrend, but reminder that the daily chart can find a higher low here still at 471. So keep your wits about you. Be open to a trend reversal at 471 as a daily higher low, right? You have lows and then higher lows over here. What about the anchored view apps intraday? Any confluence from this point of view? what you'll notice is that we're above all of the anchored view apps, and we are getting some confluence loosely around 471 if there is a more aggressive pullback on the failure to hold at 473.25. Let's take a quick look at what's happening from a market internals perspective. Got my screen switched up there. Today's session, certainly substantial inflows. What I'm going to do is just remove that historic breath and take a closer look at the individual day today. Breaching 300 million positive does strike me as a bullish indication, and the breadth ratio read throughout the duration of the day was hovering anywhere between 3.5 positive at the worst, all the way up towards this 6-to-1 positive. So that really validates the breakout that we saw in the upward direction. These are strong buyers, not really just like consolidation. We'll throw some money at the market. No. These are solid buyers, right? Same thing over here in the advanced decline line being up in trend higher zone on today's session, validating the breakout. And look at the cumulative build. It's certainly not breaching positive 5,000, but it did build steadily throughout the course of the day. What this would indicate to me is that we don't just have a short squeeze. Remember that if the market, the cumulative tick, if the read looks something like this and then flatlines into the afternoon, it's a morning squeeze met with just afternoon grind, whereas this is steady improvement at the exchange level through the duration of the day. Here's the market profile now, so we could take a look at what's happening from a spike point of view. So here it is over on the ES futures. There's your M period spike. Just to illustrate it over in the market profile, again, the idea here is if we open in or above the spike, bullish things should happen. The market should continue to auction in the upward direction. If we reject these prices, just think about it as buyers are trapped, right? Anybody who bought that breakout into the end of day and then opens back in value underneath, they're like, they're scratching their head. Maybe it's not the end of the world and we don't kick off a pullback until we break underneath this mechanical level. You can see it as a TPO shelf as well as value area low. To give you the futures level, that would be at 48.08. If you break down underneath that, maybe you kick off a little bit of a stronger pullback. But for now, it's all about the spike into tomorrow's open. I'll give you the spike base as well at 48.17. QQQ daily time frame chart, you can clearly see just traded a brand new all-time high, and by nature of doing so has produced a higher high for the trend count. So buyers remain firmly in control. It means that we can afford a higher low pullback. The first place I would be thinking about is the two-day highs that led to the breakout in the first place at 406.25. Remembering that tech represents about 28% of the S&P 500, we'll use the Qs as a proxy for the XLK today. This does strike me as bullish supporting evidence that the S&P can continue in the upward direction. We'll talk about the nuance of the spike and how we should trade this tomorrow morning in the pre-market prep. If you're not familiar with that, it's here live on the channel every morning at 8:15. It's free and open to the public. Hope to see you there. Let's jump along though and take a look at the IWM. What's going on with small caps? This is actually a very interesting indication which furthers the bullish nature of the broad market. Not only are we in a pretty firm uptrend at this point in time with consecutive higher lows and higher highs along the way, which cements the uptrend in the first place, but we broke out of the 3-day balance range after the gap up from Thursday of last week, furthering the gains that we've seen in small caps, is basically saying that, hey, the broad market, the rally is actually broadening, for lack of a better term, right? Instead of being led by the Magnificent Seven, things are broadening. The Russell 2000, right? It's the Russell 2000, it's the SPY 500, S&P 500, it's the QQQ NASDAQ 100, right? The fact that the 2000, IWM, the broadest small cap index, is sort of playing nicely in the upward direction does strike me as, again, a constructive look that actually ties directly into the sentiment for the S&P 500, right? This is a bullish indication at the exchange or just like, economic level to see small caps participating in the upward direction. Basically, you could take all of the breadth charts that we covered in last night's episode, along with the risk appetite charts, bake them into one, and you basically get the IWM. If this is pointing higher, it's definitely more of a risk on indication for your S&P. Let's move along and take a look at two other charts before we talk about fundamental valuation. Someone made a great comment the other day, last night, about financials moving higher because of the unrealized loss in bonds actually moving downwards. So the unrealized loss is getting smaller. They're getting closer to break even on those bond portfolios, which in turn reduces the risk in the bank, because don't forget, a bank is technically a company, right? And therefore, the less risk in the company, the more valuable it becomes. So rates moving lower, although they're not making as much money on rates, their unrealized losses are getting smaller, which is bullish for the fundamentals of the company overall. That was a great point. I'll put a snapshot up now of who made that comment, always giving credit where credit is due. The last thing to point out before fundamental valuations is the HYG. It is the only supporting evidence chart that I could find tonight as I was looking through, that is a little bit more hesitant about continuation. Notice that we have an equal high in the HYG, whereas we broke to a higher high out of equities down below. A subtle divergence if we were to break down through what could be construed as the neckline here at 76.77. I would put my thinking cap on and say it wouldn't be unreasonable for equities to see a little bit of a pullback. But other than that, all of the sector ratios, all of the bonds, all the credit spreads, all of the breadth indications we're watching remain on the bull side of the market. From a fundamental perspective, the market really just cares about the Fed and possible rate cuts in 2024. And Barkin came out this morning with a little bit of a head scratcher. I don't know if this guy lives under a rock, but he said it's possible that if inflation keeps falling, we'll suggest rate cuts would be appropriate. And he must just, again, be playing the psychological warfare against the market, because Jerome Powell clearly illustrated in the summary of economic projections, as well as during his press conference after the FOMC on Wednesday of last week, that we have at minimum 2 rate cuts in the pipeline. That's getting from a 5.1 projection in 2024 to 4.6. if not more. And if we're taking a look at what inflation is doing, if this is dependent on inflation, then, I mean, my goodness, of course we're moving in the right direction. Now, don't get me wrong, we still have high inflation at 3.1 on the year-over-year read. We want to get closer to that 2% mark, but look at what PPI continues to suggest, that inflation will continue to move in the downward direction. I wouldn't go so far yet to say that the Fed has a deflation problem, but if we start aggressively seeing year-over-year fall to 0.2, 0.5, those types of reads, of course that would start to become an issue for our market. And the market's already pricing in that, hey, maybe it is going to turn into an issue if the Fed doesn't act quickly enough, with the projection of not 3, which is on the higher end of what the SEP would suggest, but 6, double what the SEP would project, 6 rate cuts. 6 rate cuts in 2024, just absolutely incredible. And the market has rallied on the premise that money will become cheaper. This is a PE expansion rally, not an earnings rally. So let's firstly take a look at the SEP. Here you go, from 4.6 to 5.1. That's 50 basis points, or 0.5%, of a reduction of the median projection for 2024. Remember that September, which bumped up from 4.6 to 5.1, was what really kind of set that top in motion from August. We got the repricing back down to 420 over in the S&P 500. A little bit lower than that was the monthly higher low. Now we're back to 4.6, right? So this is making sense as to why the market has rallied, at least to the summer high. But what explains the move through the summertime high? Let's take a look at the earnings report from FactSet. What you'll notice is that earnings are absolutely in the gutter for calendar year 2023. Bad. Certainly decreasing for 2024. And if you take the current earnings per share, or the projection for 2024, we have 245.40. And then if you take the PE, or the multiple, basically, let's scroll down a little bit. There we go. For the S&P 500, the forward PE currently right here is 19.3. Just for round numbers sake, that gets you close to 4,700 in the SPX. So the market has already traded not only to the equal high, but towards that 4,700 under the pretense that we've priced in fully what we're expecting for 2024. Now, we know that the market's a forward-looking mechanism, but what does this leave for meat on the bone for the S&P? The market rallies because ultimately what it's seeing is we're projecting 6 rate cuts here. And now, instead of just having a mild PE expansion, we can actually scroll down to this chart over yonder. Instead of seeing this, which is just basically moving to the high of the summer, remember that this is where the September projection was made. This is now where the most recent projection is made. If we get 6 rate cuts, this will continue to move in the upward direction and we'll be trading at a PE that's more so aligned with 22, give or take. And let me do the math on a calendar. I've got it in front of me right now. I promise this will just take a moment. If we take 245.4, multiply that, which is the EPS for 2024, by 22, that would project about a 5,400, I just did the math, 5,400 SPX by the end of calendar year 2024. So if this continues to move higher, if we get a rally that's purely based on a PE multiple expansion, which comes from rate cuts and the reduction of the cost of money, that's how you could get to a 5,400 valuation for the S&P equities. If this stalls out, if it just kind of goes sideways, if Jerome Powell stays firm to his guns, we're going to have an issue, and the market's basically priced fairly currently at roughly 4,700 for 2024. So two things need to happen. Multiple expansion or earnings really need to get in gear in the upward direction instead of this thing fading off into the sunset here. Sure, there's a delta between the 2 years, right? But it needs to start perking up. It needs to start trending in the upward direction if you're looking for the market to be fruitful in 2024. Otherwise, we've mostly priced in what's already taken place. That's all I've got for you for a fundamental run through of this market. We'll be back tomorrow for not only the pre-market prep at 8:15 on the morning session to take a look at that QQQ and build a game plan for the day, but we'll also do a full run through of all of the charts, sectors, supporting evidence after the close tomorrow for our typical Wednesday update. If you enjoyed today's breakdown as a little bit of an intra-week gift, let me know down below in the comment section or by giving the video a very simple thumbs up. And with that said, I wish you a green trading week.